Hey everyone, welcome back to the channel. If you're into stocks, tech plays, or just spotting those golden opportunities in the market, you're in the right place. Today, we're talking about something that's got Wall Street buzzing. TTD stock plunges 40%. Is this a massive buying opportunity? Yeah, the trade desk's shares tanked hard after their latest earnings, but is it time to scoop up the dip or run for the hills? Stick around, because I'm breaking down the drama, the numbers, the risks, and what smart investors are doing next. Let's dive in. First things first, if TTD is new to you, let's get you up to speed. The Trade Desk is a powerhouse in the digital advertising world. They're not your grandma's ad agency, they're a tech platform that helps brands buy ads programmatically across the internet, television, apps, you name it. Think of them as the middleman making sure your ads hit the right eyeballs at the right time, using AI and data to optimize everything. Founded in 2009, they went public in 2016, and they've been riding the wave of connected television, CTV, retail media, and the shift away from cookies. Their Kokai platform is like their secret sauce, using AI to make ad buying smarter. In a world where Google and Amazon dominate, TTD stands out by being independent and focused on the open internet. So, what the heck happened? On the 8th of August, 2025, right after dropping their Q2 earnings, TTD stock cratered nearly 40% in a single day, their worst drop ever. Shares went from around $88 to as low as $53, wiping out billions in market value. Trading volume exploded to over 35 million shares, way above average. It was pure panic selling. But here's the twist, the earnings weren't even bad. In fact, they beat expectations on the top line. Let's crunch the numbers. For Q2 2025, revenue came in at $694 million, up 19% year over year from $584 million in Q2 2024. That's solid growth, especially when the overall digital ad market is only growing in the low teens. Net income, $90 million, or about 13% margins, slightly up from $85 million last year. Adjusted EBITDA hit $267 million, a healthy 38% margin. They even repurchased $261 million worth of their own stock, showing confidence with $375 million still left in the buyback program. CEO Jeff Green called it a strong quarter, highlighting wins in CTV and retail media, where they're partnering with big names like Disney and Walmart. Their OpenPath tech is gaining traction, cutting out middlemen, and saving brands money. But if the results were good, why the massive sell-off? A few culprits here. First, guidance disappointed the street. For Q3, they're forecasting at least $717 million in revenue, which is about 17% growth, and $277 million in adjusted EBITDA. Analysts were hoping for more aggressive numbers, especially after a hot Q1. Then there's the CFO shakeup. Longtime finance chief is stepping down, and Alex Kayal, a board member and early investor, is taking over on the 21st of August. Transitions like this can spook investors, even if Kayal brings tons of experience from Salesforce and ad tech. The real gut punch? Macro worries. CEO Green warned that potential tariffs, think trade wars, and economic uncertainty are making big brands hesitant to spend big on ads. With elections looming and inflation still a thing, companies are pulling back on marketing budgets. Plus, fears of Amazon ramping up competition in ad tech. Amazon's already a beast in e-commerce ads, and whispers of them poaching TTD's turf sent shivers. Add in broader market jitters, tech stocks have been volatile, and boom, 40% wipeout. But hold up, it's not all doom and gloom. The stock's already bouncing back a bit. As of the 12th of August, 2025, shares are hovering around $53, up slightly from the lows. And guess who's buying the dip? Cathie Wood, the ARK Invest guru known for bold bets on disruptive tech. Her funds scooped up over 725,000 shares right after the crash, adding to her massive position. That's Cathie saying she sees value here. Other big names like Vanguard and BlackRock hold huge stakes too. Analysts are mixed but leaning bullish long term. Out of 30 ratings, most are buys with an average target around $95. That's over 80% upside from current levels. Firms like Piper Sandler and Needham reiterated buys, calling the drop overdone. Why the optimism? TTD's fundamentals are rock solid. They're growing faster than the industry, with CTV revenue exploding up over 30% as streaming takes over traditional television. Retail media is another gold mine, expected to hit $100 billion globally soon, and TTD's partnerships position them perfectly. Their AI-driven Kokai platform is a game changer, helping brands navigate a cookieless world post Google's privacy changes. Plus, they're debt-free with over $1.5 billion in cash, giving them firepower for more buybacks or acquisitions. Year to date, even after the plunge, TTD's up about 15% not bad compared to the Nasdaq's roller coaster. Market cap's around $26 billion, trading at about 12 times forward sales, which is a steal for a high-growth tech play. Historically, they've compounded revenue at 40% annually since IPO. Of course, no stock's a sure thing, and TTD has risks. Ad spending is cyclical. If the economy tanks or tariffs hit hard, growth could slow. Competition's fierce. Google, Amazon, and even Meta are gunning for the same dollars. Regulatory scrutiny on data privacy could throw wrenches, especially in Europe. And that CFO change? It might signal internal shifts, though the new guy's an insider. Volatility's baked in, remember. Shares hit $141 highs earlier this year before pulling back. If you're risk averse, this might not be for you. But if you're bullish on digital ads, which are projected to grow to $1 trillion by 2030, TTD's your ticket, they're the pure play leader in programmatic with a moat from their data and tech. Wall Street sees them hitting $1 billion quarters soon. Some analysts, like from Seeking Alpha, are upgrading ratings, calling it time to catch the falling knife at these levels. So, what should you do? If you're in it for the long haul, this dip could be a gift. Consider dollar cost averaging to smooth out the bumps. Dive into their investor presentation from August 7 for the full scoop on Kokai and CTV. Watch for Q3 results in November. If they beat again and macros improve, we could see a quick rebound to $80 or more. Keep an eye on ad spend trends and Amazon's moves. All right, that's the deep dive on TTD's wild ride a beat and raise earnings turned bloodbath, but with serious upside potential. If this fired you up, smash that like button, subscribe for more stock breakdowns, and comment below. Are you buying TTD on the dip or sitting it out? Let me know. Thanks for watching. Stay savvy with your investments, and I'll catch you in the next one. Peace.